Thinking about launching a podcast but overwhelmed by all the moving parts? At TurnKey Podcast Productions, we take the hassle out of podcasting so you can focus on the talk, not the tech. From concept to launch, guest booking to post-production, we handle everything. Need a strategy to grow your show and turn guests into clients? Yep, we do that too. DIY or done for you, we've got the solution that fits. Whether you're just getting started or ready to scale, TurnKey is your behind-the-scenes podcast team. TurnKey Podcast Productions. Your voice, your message, fully produced. Learn more at turnkeypodcast.com/contact. That's turnkeypodcast.com/contact.
They actually have a plan for today's Nice Guys on Business podcast. You don't want to miss it.
I don't think the financial planning world teaches anybody, really what I think is the right way. So I think most portfolios should be built from a foundation of recurring cash flow.
Yeah.
And then once you've got sort of that foundation, then you've got some play money and you can go do IPOs, or you can go do a land speculation or invest in a development deal or whatever. But the whole time you've sort of created your own safety net of recurring cash flow. And there is no better recurring cash flow asset than real estate. And in my opinion, commercial real estate, but you can do it with residential too. Well, it just takes a lot more work.
Hey, Nice Guys, I have a new strategy. Let the Wookiee win. Go from where you are now to where you could be. Get expert tips to grow your business, to be more productive and more efficient, whether you're trying to build influence, grow your community, or make it rain. Best-selling author of Nice Guys Finish First, Doug Sandler, can lead the way. The Nice Guys on Business is produced by TurnKey Podcast Productions. Now, here's your host, Doug Sandler.
All right, Nice Guy community. Today's guest is Stewart Heath. He's the founder and CEO of Harvard Grace Capital, where he helps his clients build wealth faster through truly hands-off commercial real estate investing. Now, with more than 35 years of experience and a CPA's eye for smart deals, Stewart specializes in generating passive income, reducing risk, and maximizing tax efficiencies. He's raised millions through multiple syndications, and he had hosted, and it's still live, a show called Growth, Grace, and Prosperity. That's a podcast where he explores what it takes to succeed in business and in life. Today, he's breaking down why passive commercial real estate remains an underused wealth strategy and how to diversify income without sacrificing your time or your sanity. I'm excited to chat with him. Stewart, welcome to the Nice Guys on Business podcast.
Thank you, Doug. It's an honor to be here. I really appreciate it.
Happy to have you here. And, for a guy, me, that has had my hands in some commercial real estate opportunities, I have currently 4 pieces of commercial real estate that I'm a minority share owner, so I don't have any voting rights or anything like that. I love the idea of talking to others that have other ways within the commercial real estate environment to diversify their income. So let's talk to my community about that. Where did you find that this was like, this wasn't, you weren't on the playground in 4th grade and said, you know what, I'm going to go into commercial real estate when you were in elementary school. When did this hit your radar screen that this is a good way to go?
Well, it's interesting. You and I were talking before recording that we're both about the same age, and so which makes us officially old guys. But
agreed.
So I came out of college in 1985, and the very next year they came out with the 1986 Tax Act, which was just devastating for a whole bunch of classes of commercial real estate for several years. And so I think about it. So I was a baby business person. I was just learning, and I'm just all right and reading the news and taking the news at face value and all this kind of stuff. And I remember going to meetings, on up into 1990 that real estate is bad, it's evil, and banks saying we don't even want it as collateral anymore. And it's like. And now I think back on this, that's kind of one of the stupidest things I've ever heard anybody say. So it wasn't until I left the national firm that I joined right after college and started my own firm that I started picking up small business clients. And out of out of just dumb luck, a bunch of them they were either contractors or fixers and flippers or real estate brokers, and all of whom, and they all do it all. I mean, these are just sort of real estate jack of all trade people, many of them very smart, making lots of money. And then I discovered, it just dawned on me, I'm doing their taxes. These people aren't paying any taxes.
Right.
Back then in 1992, you had a gross income of $500,000 and you're paying nothing in taxes. This is cool. And I was sort of helping to administer that and giving them advice and not really having seen the results of all that all the way through. And so that began my own interest in real estate, which I really didn't take any action on until the year 2000. And then I started in duplexes and condos and doing residential real estate, which I don't do anymore because I hate that stuff. I mean, people are crazy.
A lot of maintenance in residential real estate.
And so I've been doing it for a number of years, and think that we're pretty good at it now. And now we run syndications for people who were like myself. Busy professionals, the classic avatar, doctors, dentists, entrepreneurs who got maybe they've already had one exit from a business or they've got one that's just blowing and going now, and they've got cash flow. And what I would encourage anybody to do as soon as you get the chance, start creating multiple streams of income. Mm-hmm, mm-hmm. And you can do that with multiple pieces of real estate, or you've got a real estate stream, and maybe you come over here and you do a dividend strategy with stocks. But I don't think the financial planning world teaches anybody, really what I think is the right way. So I think most portfolios should be built from a foundation of recurring cash flow.
Yeah.
And then once you've got sort of that foundation, then you've got some play money, and you can go do IPOs, or you can go do a land speculation or invest in a development deal or whatever. But the whole time you've sort of created your own safety net of recurring cash flow. And there is no better recurring cash flow asset than real estate. And in my opinion, commercial real estate, but you can do it with residential too. Well, it just takes a lot more work.
I want to break in for just a quick second because I want to discuss this and talk about this so that my audience can follow along with us. And typically, if Nice Guy community, if you're in the stock market, unless you have a dividend paying fund, you're not receiving any recurring revenue from that. You're watching it go up and go down, and that's great. And you're investing dollar cost averaging. You're investing money when the market is down, and you're investing when the market's high. So on average, you're probably going to get a return if past performance. I know it doesn't dictate future results, but at the same time, stock market's a pretty good, long-term plan. But it doesn't necessarily generate a cash flow situation for you like commercial real estate or even residential real estate can. But I'd love to talk about like what an ideal or what a typical model looks like in your world. What types of things is your group investing in, and why is it that my audience, if they decide to take advantage of this, can get cash flow out of this as opposed to doing something like the stock market?
Yeah. And I want to be, upfront. I've got stocks too.
Right. As do I.
And not a small amount or anything, but it's just, but there's a place for everything in your portfolio is what I would say. So, but the reason why you should really consider real estate, one, and this is what we say, we provide investments for that core foundation of a portfolio, the boring stuff, which is actually our motto, is that boring is beautiful. But we provide that.
I love it.
We provide that because if you ask your financial advisor, you say, all right, I've got $1 million portfolio. How much cash can I get off of that every year? What are they going to tell you? About 4%. It's the standard industry answer. And I'm just, that's how I lost my hair. I mean, it makes me pull my hair out, and because it's insane. So our portfolio of assets is throwing off 13% cash on cash on average this year. Okay, and like I said, and we bought it we bought it well, but we bought it stabilized, and if we can throw off 13%, I mean, that's just it's just anything 10 or above is just awesome for a cash flowing asset.
Can I throw in a couple of other things, and this is to your benefit, and maybe you
Sure.
can correct me if I'm just ignorant and don't know the whole story about all of the things, but there's two things that we're missing that don't even come into the equation when it comes to, 10, 12, 13, 15% return. One is the appreciation of the asset itself. So when the asset
Right.
gets sold, you have a nice chunk of change. And the other thing is the where was I heading with this? Hold on a second. We had and things like the depreciation and other stuff that goes into it as well. So you have these other two things in addition to the cash flow that you get these other two bumps, and it's like, oh hell, why wasn't I in this to begin with all along?
I was going there. So 13% is just the current cash on cash we're paying out right now. And that's before the individual investor applies the tax benefits that come out to it.
Right.
Some of them will get to use more depreciation than others. It depends on your personal situation, but it's at least going to cover the income for the first few years that you're getting off of that investment. So you take 13% tax advantage, that's probably equivalent to 15 or 16%, pre-tax. And I mean, where do you find that? And I'm not special in that. I mean, there's a bunch of people in my business that are able to do this. I'll just say there's one disadvantage in my mind to real estate versus the stock market or anything else, and that's liquidity. You do this and you're in for 5 years or sometimes shorter, sometimes longer, but you got to wait till the whole asset before you, quote, get your money back.
Right.
Now, we do refinances often and we get people their money back as often as possible. But leave them into the deal and it just sort of begins to snowball. But so that's liquidity is the one disadvantage of that. And I think there's some blockchain technologies that are going to resolve that in the next 4 or 5 years too, but that's a rabbit trail. So.
No, I totally get it. And if liquidity is your issue, then maybe and that's one of the things that you really demand as a part of an investment opportunity. Then I would always tell you, hey, maybe this right now isn't the right opportunity for you, right? Is that
I've had that conversation many times, and I would say the stock market's not right for you either. There's some money market options and stuff like that. If liquidity is your thing, and everybody needs to have a certain portion of their portfolio that is liquid,
right,
and pretty much risk free. But real estate's not for you if sudden liquidity is your thing.
So let's talk about the ideal profile of someone that's listening to this show. So somebody could say, okay, this is an episode I want to continue listening to because I fit the quote unquote the qualifiers, or hey, I love the idea, but I'm not ready for it yet. So can we talk about the ideal characteristics of someone that would be running through an opportunity that you might be able to present to them? Like what would be the ideal person?
The way we structure our deals, and most people are probably aware that to sell securities to the public, you got to meet certain regulations, and we fall under an exemption rule called Reg D and 506C, which means we can only offer our securities to accredited investors. And those are people that are accredited by a third-party source. There are some others where you can just check the box and say, I am. But because we generally solicit, they have to be a third-party verified, which can just be a letter from your attorney or CPA.
Right.
An accredited person is essentially somebody who makes over $200,000 a year for the last couple of years, or they have a net worth over $1 million, not including their home. It gets more detailed than that, but those are generally the parameters. So if you meet those kind of one or both of those criteria, then you'll be welcome to look at anybody's. Reg D deal, private placement deal, which is what most real estate syndications are. There are some people out there that are doing something that doesn't have restrictions called Regulation A, but they're much less profitable than what most of what you will find in the private market.
And then let's talk about, does it matter what the asset is that you are investing in? I'm sure it does matter in the long run to get the gains or to get the returns that you may be looking for, or to continue your profitable investing.
Yeah.
But what I, again, boring is better. I like that as well. I don't want anything too exciting, because exciting means a lot of flash, and I'm not looking for flash. I'm just looking for a good, solid investment opportunity. So what does that look like in your case for your group?
Well, we call ourselves asset class opportunistic, or almost agnostic. Our current holdings are office buildings, which some people will freak out over. But depending on what part of the country you're from. But we do some retail strips. We have some storage. We underwrite a lot of multifamily, which is sort of the queen of commercial real estate. But one of our rules is that this property must be stabilized and it must cash flow based on the price we're paying from day one. Because we can't do what we do if we got to wait a couple of years for cash flow. And so I've never yet found a multifamily deal that happens. And there's always a lot of competition on a multifamily deal. So really, what makes it special is our rule. And I mentioned to you before, so we wrote a book which has got my 10 rules for buying real estate in it. Rule number one is you make your money on the buy, not the sell. So being able to, your cash flow for the first 4 or 5 years will be almost completely dependent on the price you paid up front. And if you pay too much, then your cash flow goes down. It just makes simple mathematical sense, because sometimes you can get caught up in a deal and you just get, well, I've got to get it. I've got to get it. And you'll be paying for that decision your entire hold period. Right. So, it gets a little bit complex, but so to us, it's just about the math. We do invest in a particular geography, which is basically from Nashville, Tennessee to Birmingham, Alabama. And as our team grows, we'll expand that territory as well. But we also do the hands-on property management, so we have to be relatively close by. So those are the key triggers that we're looking for. It's got to be stabilized, got to be cash flow, and we got to buy it right. And then you drill down into it's got to be a great location too.
Oh, of course, yeah. The key to investing is location,
yeah.
location. Those are the most.
It truly is, yeah. And I'm just like, yeah, that's not at a city. That's at a neighborhood level kind of right. Analysis. So.
Now, you mentioned the geography from Tennessee to Alabama, some specific places within those states. If somebody is listening to this and they are outside of that parameter, does that matter at all, or do you prefer people to be in that geography?
No, not at all. We've had about 91 people invest with us in the deals we've done to date, and they span from Florida to California. It really just depends on how we met and developing the relationship and networking, and everybody knows how that works. So clearly, because our core network is in Tennessee and Northern Alabama, most of our investors are from there. But I've got 24 or so down in the Tampa area, and got some in Atlanta and a couple in California. And it does not matter. And that's the beauty of doing a private passive investment deal. We actually had a group came over. They've got an American base, but they raise money in China, and they put a pretty good piece of money into our last deal. And so, I guess now you have to say we're international. So,
what I found is so great about working within some of these investment groups is that the relationships that you build, whether it's through the managing partner and the investor, or maybe some of the partners, the minority partners that are in the group, is that once you're in one of these groups, the opportunities continue to present themselves. You're in on one
Yes.
commercial deal and another one comes up, and you're oftentimes given the first opportunity for, the first right of refusal on that next property. And
Yeah.
you don't have to go through the whole dance in the beginning that you may just to establish trust, get to know the people that you're working with. And what's so nice about it is that you probably do regular reports, maybe quarterly or maybe even monthly reports. You have
do monthly reports,
monthly
and quarterly
reports.
distributions. Yeah.
Right, you get quarterly distribution. You have access to all of the paperwork all the time. It's really easy to make the handoff to your accounting team. All of that stuff. It makes this kind of opportunity so wonderful and so easy, and you're not worried about, oh crap, look at what the stock market did today. If you're well diversified, and I try to be as well diversified as possible, and I'd love your comments on this. You're looking at the stock market, and when you're the Magnificent Seven and they're going down 20% in any given week or month, you're like, oh shit, there just went, $100,000 of my dollars. And now I got to get that back. It can happen in real estate. It just doesn't happen the same way in real estate oftentimes.
Yeah, there's no perfect or riskless investment. But we try to de-risk them as much as possible. And I can talk through that as well. But there is not the volatility in real estate.
Mm-hmm.
It is the oldest market in the world and the biggest market in the world. And if I can get on another one of my soapboxes for a moment, and I think you started out saying, why aren't more people doing this? Is because, the financial industry, Wall Street, has done a tremendous job of, now they take real estate and they call us alternative. I'm like, alternative, my butt. We're the original asset class. Since a couple of cavemen did a deal for, 2 goats a week or whatever, it's the original deal. And it's the safest. Everybody has heard a real estate horror story. Yep. Yeah. And we've all heard of stock market crashes too. And yes, it's not riskless. It's called investing for a reason.
Mm-hmm.
But it is far more stable. You don't have the potential for daily fluctuations unless a tornado comes down and wipes out your property. And you're most likely insured. And then you can leverage, which you can do some of this in stocks, but we have a maximum leverage of 70% that we'll do on a deal, but that just enhances everybody's returns.
Mm-hmm.
It's relatively safe at 70%. It's not crazy that you would have a 20% correction in the real estate market. It's not going to last very well, but we've all lived through the great financial crisis.
Mm-hmm.
And so there were 20 and 30% corrections then, but at 30%, the bank is still your partner and they're not your enemy at that point. And then we build in reserves to take care of unexpected issues, like suddenly all your tenants moved out. Very unlikely scenarios, but because you don't know what you don't know.
Right. Well, I appreciate you sharing all that information. Now, before I hit record, one of the things that you had mentioned, or one of the things I mentioned, and then you mentioned something else, is that although you're not actively putting published episodes out, you have some really great guests that are talking about evergreen content on your podcast. You have 60 episodes or so of your podcast. So I'd love you to give a plug for that, and then we'll put a link in the show notes for it as well.
Yeah, we may bring that back up again. But the Growth, Grace, and Prosperity podcast is, I think, pretty much everywhere that podcast can be found. We brought in entrepreneurs, business leaders, a lot of people who'd started their own gigs, and they just come and sort of tell us their story, tell us what they learned. My favorite question was, what was the most unexpected thing that happened to you and how you dealt with it? Because at our age, that's really the story of our lives. It's like, we don't even talk anymore. Well, when I was in college, I made this plan and everything went according to plan. Well, nobody has that story.
No, very rare. Very rare.
But so I love the entrepreneurial stories of the guys who, and some of them just like say like you said, tremendous stories of just really overcame some tremendous business and or personal obstacles along the way and still achieved great success. So yeah, thank you for mentioning that.
Yeah, and then the other thing that you had talked about is, did you say that you have a book
I do.
Okay,
Yeah.
great. Talk about
Yeah.
that for a second, because I'm sure those in our community would like to find out more info about it.
Yeah, it's called Don't Do What I Did.
Mm.
My 10 Rules for Investing in Commercial Real Estate. So I've been doing this for a long time. I've made a bunch of mistakes. And so now I've compiled, my rules, and we actually operate by these rules realistically in real time as we do our underwriting team. And it's like, well, this violates rule number 4. So, okay, it's gone. Yeah, and so we can send anybody. We're still behind getting it up on the website. I'll send anybody a free coupon to get a free electronic copy, and then sometime next week it'll be available on Amazon if somebody just wants the hard copy.
Nice.
But yeah, I hope it's really helpful. I've got some real life of my own stories, and then some good resources for anybody who wants to start looking at real estate themselves. Here's some tools to use. Here's how we deal with this. So it's not a big heavy read, but I think it's a very practical guide.
I'll put a link in the show notes for that as well, and I'll make sure that and I'm looking at your website right now. There's a contact us page, so if you want to get a copy of the book, probably right now the best thing to do is just fill out the contact us page, and in the comments area, just
Today,
write.
I can, and after the show, I can actually send you the QR code they can use if you want to put that out.
That's perfect. That's perfect. Yeah. We'll make sure we do that. What should I be asking you that I am not asking you, Stewart? I know we covered a lot of stuff. I'm sorry I took over in some cases of the conversation. Yeah. It's just one of those things that I love the conversation of creating passive income, and I love the idea of doing it through real estate, especially the type of real estate deals that you're putting together. But what should I be asking you that I am not?
Yeah, so I would just say, and this goes for anybody who's like, all right, well, how do we get started? And so I think the question is, well, when is the best time to get involved in this? There's the old joke: when's the best time to buy real estate? 5 years ago. Right. When's the best time? When's the next best time? Well, today.
Right.
And timing is still key. And anybody who follows the financial news like I do, we've been hearing about the financial wall, the debt wall that was going to come crashing down from the fall of 2022, up until last week. Mm-hmm. And banks have been working with different borrowers and stuff, helping work these things out. So we really haven't had the massive debt crisis of foreclosures and stuff like that, because banks and borrowers have been working together. And for them, in most parts of the country, these properties turned around themselves, so they didn't have their problems. So where I'm driving at is, what does it look like over the next 12 months mm-hmm. As far as getting into this market? Yeah, I feel like, and I can see it in my deal flow right now, we are finally getting to the point where sellers are willing to sell at cap rates, above 6%, and which is what they were getting when interest rates were 3.25%. Mm-hmm. And sellers, they either need a liquidity event, or they've given up that interest rates are not going back to where they were mm-hmm. at the beginning of 2022. And so you've got that. We have commercial rates coming down, and so you've got this group of people who need to sell their properties and people who want to buy, but not at 8%, right. debt. And so it's sort of the opposite of a perfect storm. It's a perfect marriage, if you would, of buyers and sellers. And I think the next 12 to 18 months is just going to be, for guys like me, just going to be a target-rich environment. We're going to be able to buy some stuff at some generationally low prices. I think it's going to kick off the next wave. And dare I be so bold, I think that wave is going to run for many years, and we'll probably be looking at several exits in 2030 to 2032. Well, and so anyway.
Yeah, all of that sounds great for guys that are in their 50s or 60s right now. It sounds like it's a great opportunity for those that are looking at retirement horizon, in the next 5 to 15 years.
Yeah.
Sounds like it's a great cash flow provider when you're in retirement. I would really encourage everybody to head over to Stewart's website. We'll make sure we put a link in the show notes, but it's harvardgracecapital.com. Check it out. Go to the contact page on his website. Fill out the information. Get a copy of his book. Put that in the little comments area and say, "Hey, I want Stewart to call me," and figure out if this is a good opportunity for you. Does that work for you, Stewart?
Absolutely. I welcome anybody and everybody to book a call. You can probably find my Calendly link on the website as well, and I can talk about this stuff all day long. Happy to help. And many people I've talked out of doing it because I just don't think it's the right fit for them. So,
Understood. Well, thanks for being.
I'm still a CPA, and I will wear my consultant.
No,
hat.
I got it. I mean, that's the best thing, because if not, you got a guy that's invested or a woman that's invested in one of your programs, and they're calling you every 3 minutes because they're worried about the market. Stewart would prefer not to have that person. So let's get you on.
That is true.
Get you on the phone with Stewart to make sure that that it is the right opportunity for you. Stewart, thanks for being on the show. Thanks for sharing your expertise.
Thank you, Doug. Really enjoyed it.
Hey, Nice Guy community, never underestimate the power of nice. Again, special thanks to Stewart Heath. All of his information, including access to his website at Harvard Grace Capital, will be right there in the show notes. Steve O'Brien, go ahead and take us out of here.
For the Nice Guys on Business, I'm Steve O'Brien. Seriously, it'll only hurt for a minute or two. 10 tops.